This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Thank you for joining me. It is Wednesday, October the 5th, 2016. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle, as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term, risk, and the short term is about confidence and sentiment. This month, I'd like to cover a range of linked topics shown here regarding what I see to be a concerning combination of pyramiding risk and systemic instabilities. Some simple back-of-the-envelope arithmetic shows why, though we have experienced a so-called economic recovery, the central banks of the developed economies must still flood the financial markets with over $200 billion per month. The global debt burden is simply too great relative to real wealth creation. Exploding credit growth has been sustaining the mirage of economic growth, but has slowed and is becoming more problematic than helpful. Either real debt financing must be reduced further, even with $12 trillion of global debt already priced at negative interest rates, or global growth somehow must further be stimulated. There is little doubt in my mind that central bank balance sheets will be further increased in 2017. I personally see coordinated, massive infrastructure fiscal stimulus becoming a hot subject soon after the U.S. elections are concluded. We have long ago crossed the Rubicon where the global economy is on credit life support until an economic miracle occurs or the economic distortions and unintended consequences of monetary malpractice leads to yet another financial crisis. The next financial crisis, if it is allowed to happen, will be global in nature, much larger, and incredibly more complex to resolve. Policy setters are acutely aware of this, and therefore we can expect there to be no extent to which they will not go to avoid this from occurring. The policies of extend and pretend and kick the can down the road have become a marathon endurance test with no finish line in sight. As the CIO of Allianz stated earlier this week during a Bloomberg interview, government programs to sustain this marathon, such as financial repression, will be, and I quote him, will be with us for the next generation. What we must understand, however, is that central bankers and governments have not yet successfully obsoleted the business nor the credit cycles. They may have the means to temporarily delay the inevitable, but they simply don't have the power to stop the momentum of longer-term cycles or trends. We are watching global profits, as measured by earnings per share, steadily fall, despite historic levels of stock buybacks as a result of cheap money and debt-burdened corporate balance sheets. This is the savings, or the wealth, that is required to fund and carry the existing debt burdens we just calculated. It is the basis upon which a healthy capitalist system operates. I think it is safe to conclude that the system is presently not yet healthy, nor stable, nor without high levels of risk. The problem is a global problem. Global trade levels continue to fall precipitously. It is a developed, emerging, and frontier economies problem. Globalization makes it all one economy today. We have not experienced a global recession before, and it is difficult to comprehend exactly what that would mean and how policy setters would effectively address such an occurrence. Or could they? The IMF, the World Bank, the OECD, and the BIS, or Bank of International Settlement, are all warning, in the strongest of terms, the problems they each individually see. They continue to bring down global growth expectations as they ratchet up the warning rhetoric. However, they are incapable of actually fixing any of the problems. The solutions and actions lie within the domain of sovereign politics, which at the moment is a massive problem in itself. The global engine of growth that can change this is the largest economy in the world, the U.S. However, by whatever metric you choose to use, the U.S. is on the verge of a recession. The four factors shown here have preceded every U.S. recession but one, and the conditions for that exception don't exist today. The U.S. equity markets have a close correlation with nominal GDP, and though net worth of U.S. households may get ahead of it due to overheated and elevated financial markets, historically the gap is always closed. Of course, this time it may be different, the words most often heard just before a correction. 2017 will be a year of growing political instability, which will make it difficult to address the global economic issues, assuming it doesn't by its nature make it even worse. 5 major referendums and elections could undermine the confidence in government. Brexit, which is now targeted to be initiated by the UK in Q1 of 2017, the US presidential election, the French election, the German elections, and the Italian referendum vote in December. The combination of these events hold the potential to overturn the expectations of the future and the abilities for decisive actions when most needed. Whatever the general public felt about government would flip. The key to a shift from public confidence to private lies within the scope of these events. This is what our annual abstraction process has been forecasting. Political instability is on the rise. This is the age of anti-establishment or third parties rising globally. However, additionally and very importantly, Social Security and Medicare go negative next year in the United States, which of course mainstream media is not bothering to report for fear that would add fuel to the bonfire of political corruption. Not to digress, but what is also not explained by mainstream media is that Obamacare is crumbling from within. The entire structural design of Obamacare was a perpetual Ponzi scheme they used for Social Security. It isn't just political instability we need to be concerned about, however. Our 40-point tipping point analysis on our site is signaling major problems ahead. The top 10 shown here don't include currently lower ranked concerns such as mounting U.S. student and auto loan problems, underfunded pensions, state and local government defaults, chronic underemployment, slowing consumer retail sales, and the list just goes on. Any one of these could be the catalyst that triggers an already unstable and highly risky financial infrastructure. So what could go wrong? Well, now we have Deutsche Bank, one of the largest and definitely most highly leveraged banks in the world. Stocks of a global bank of this scope and this broadly held within most global portfolios doesn't fall from just under $130 to single digits because there aren't some very extremely serious problems. I wrote in June when Deutsche Bank was significantly higher in price that I felt it was the Lehman plus Bear Stearns plus Enron squared problem for Europe. Deutsche Bank has almost twice the leverage ratio that ended Lehman Brothers' existence. Deutsche Bank's portfolio of bad debt in Spain, Portugal, Italy, Greece, etc. makes the portfolio which ended Bear Stearns seem pristine, and a derivatives book that is the largest in the world and larger than the entire Eurozone economy. What could go wrong here? The contagion from a potential Deutsche Bank problem is almost unfathomable. It isn't just Deutsche Bank, though. The entire European banking system, which was never fixed post-2008 and during the 2012 European problems with Greece, is a house of cards currently being held up by false confidence and a manipulated, in my opinion, bank stress tests. European banks have recently announced cuts of 20,000 jobs. Commerzbank is cutting 9,600. The Dutch giant ING is cutting 5,800, etc. The problems are broad-based. The intractable problem is most evident in the EU Target 2 accounts. Cash is flowing out of Spain, Portugal, and Italy, who are the biggest debtor nations to the German Bundesbank, and thereby Deutsche Bank and Commerzbank. We have potentially another peripheral nation EU banking crisis looming. I previously reported how the Swiss National Bank was buying the U.S. stock market, and specifically the index-leading FANG stocks. Let's hope they keep this up, because clearly the rest of the S&P 500 stocks are not getting the same attention. I have labeled this chart from John Hussman. Since corporations have to deliver cash flows both to stockholders and bondholders, the combined financial claims on a company are often best measured using enterprise value, which includes the value of both. In order to respond to the cash on the balance sheet argument, Hussman subtracted out the amount of cash held by corporations so that the chart shown here includes market capitalization and net debt. Notably, the net debt of U.S. corporations as a fraction of corporate gross value added is presently about 2.5 times the historical norm, which largely offsets the impact of low interest rates on the overall financial claims faced by corporations. The ratio of enterprise value to corporate gross value added is now nearly equal to the level observed at the 2000 market peak, but clearly shows it may have reached an inflection point. The median drawdown among stocks by decile over a subsequent 30 months is shown here. Clearly, investors paid dearly for the overvaluations of that top decile in 2000, as the median loss in that group over the subsequent 30-month horizons was more than negative 80%, very similar to the loss experienced by the NASDAQ 100 index. From their 1999 levels, all of the deciles lost more than one-third of their value over the following 30 months, with the losses in most groups approaching 50%. The 2007-2009 decline was even worse for most groups, with no groups losing less than 50% and some experiencing median losses of 70% or more from their highs. We forget all this so easily, don't we? It is important to remember how deep those losses were in the 2002 and the 2007-2009 periods, even among less overvalued groups that would recover over the longer term, and that there are now even fewer places to hide. Given current valuation extremes, Hussman's analysis suggests that the median loss for any decile of those stocks will be less than 40% over the completion of the current market cycle, and we can likely expect that losses will approach 60% more typical than not. I've highlighted this projection by Hussman in a gray band on the chart. I also label the rate of drawdown adjustment we have witnessed previously in those periods. At some point in the not-too-distant future, the pain of earning near zero interest rates in safe liquidity will be far less daunting to investors than the pain of losing the bulk of their capital. Again, when risk reversion kicks in during the completion of a market cycle, central bank liquidity does not reliably support stocks because safe liquidity is seen as a desirable asset rather than an inferior one. The next chart shows the median price-revenue ratio across all S&P 500 components since 1986. From a long-term perspective, the valuation levels we observed in 1986 are actually close to very long-term historical norms over the past century, as the pre-bubble norm for the market price-to-revenue ratio is just 0.8 in data since 1940, with the exception of 1986 and the 1987, 1990, and 2009 lows, which were moderately but not severely below longer-term historical norms. Every point in this chart is above average from the standpoint of the longer historical record. Presently, the median stock in the S&P 500 is more overvalued than at any point in U.S. history, easily exceeding the overvaluations observed at the 2000 and 2007 pre-crash extremes. We can see we have a classic technical megaphone chart, which normally plays out as shown in red. No guarantees, but usually a high probability. I've been extremely negative in this discussion so far, but don't panic quite yet. The powers to be are even more worried. Over the last 10 days, Federal Chairperson Janet Yellen, former Treasury Secretary Lawrence Summer, and even J.P. Morgan have all been out talking about the possible consideration of policy changes that would allow the Federal Reserve to buy U.S. equities. These are obvious trial balloons to condition expectations. Japan and Switzerland, amongst others, are already doing it, as we've previously reported, while the ECB is also floating its own trial balloon on the same subject. If you want to know what could create a Minsky melt-up, it is this. What is happening is basically financial repression is now in play. What is assured is that 2017 is going to be an incredible and historic year for the global markets. But, as I've been saying since 2007, don't worry, they'll print the money. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2016 turn out to be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.